When we're young, nobody teaches us how to manage money or build wealth. It's not part of the school curriculum, and most of us learn by making expensive mistakes. Sure, maybe you're doing fine now. You've got a roof over your head, food on the table, and enough left over to occasionally grab drinks with friends. But what about buying a house, sending kids to college, actually retiring someday without eating cat food? Even if these concerns seem decades away, your future self is begging you to start investing now. Tony Robbins breaks down some brutally simple investing principles in his book, Unshakeable, that can transform your financial future. Let's get into it. Rule number 1. Start investing yesterday. The single most important investing principle isn't about what stocks to buy or when to sell. It's dead simple. Start investing now, not later. If you're not investing at least 10% of your income right now, you're actively choosing to stay broke. I don't care if you're making minimum wage. Even $25 a week consistently invested will completely change your financial future compared to saving nothing. This isn't just motivational BS. It's pure math. Let me show you why. If you start investing just $100 monthly at age 20 with a 10% annual return, the historical average of the US stock market over the last century, by 35, you'd have $41,940. But wait until 25 to start. By 35, you'd only have $21,037, less than half the money for waiting just 5 years. This is the power of compound interest. It's like a snowball rolling downhill, getting bigger and bigger over time. The interest you earn starts generating its own interest, which generates more interest, and so on. Will compound interest make you rich in a year? Hell no. But the difference over 10, 20, or 30 years is life-changing. The lesson is painfully clear. Start investing a portion of your income as early as humanly possible. Rule number 2. Focus on not losing money. The secret that separates successful investors from amateurs is their obsession with protection, not profit. Your primary goal should be avoiding losses, not chasing gains. This is why Warren Buffett, one of the richest humans on the planet, has 2 simple rules. Never lose money. Never forget rule number 1. The path to wealth isn't finding the next crypto moonshot. It's consistently not doing stupid things with your money. Here's the math that proves why this matters so much. If you invest $2,000 and lose 50%, you're down to $1,000. Now, how much do you need to gain to get back to $2,000? Most people think 50%. Dead wrong. A 50% gain on $1,000 is only $500, leaving you at $1,500. You actually need a 100% gain just to break even, and that could take 5 to 10 years. This is also why trading options, futures, penny stocks, and other high-risk investments is almost guaranteed to destroy your wealth over time. The odds are stacked against you. Sure, you might get lucky once or twice, but eventually probability will catch up to you. It's like going to Vegas. The house always wins in the long run. You might walk away with a win on a given night, but if you keep gambling, you'll eventually lose everything. The math is unavoidable. Rule number 3, automate your investing. Here's the brutal truth. You are your own worst enemy when it comes to investing. The most powerful investors aren't the ones with the best stock tips. They're the ones who remove emotion from the process entirely. Every month, you tell yourself you'll invest whatever's left over after expenses, but somehow there's never anything left over. Or you decide to wait for the perfect time to invest when the market looks safer. Meanwhile, years pass by and you're still broke. Set up automatic transfers to your investment account every month, right on payday, before you can touch the money. This kills procrastination, prevents emotional timing the market mistakes, and makes consistency effortless. Think of it like brushing your teeth. It's boring, automated, and you don't even think about it. But the long-term results are massive. Here's why automation is so powerful. It forces you to benefit from dollar-cost averaging. Sometimes you'll buy when the market is high, sometimes when it's low, but over time, you smooth out the volatility. Let me show you the difference. Manual investor Jake decides when to invest based on how he feels about the market. He invests $1,200 in January when he's optimistic, nothing in March when the news looks scary, $600 in June when things seem okay, and skips the rest of the year. Total invested, $1,800. Automated investor Sarah invests $200 every single month, regardless of market conditions. Total invested $2,400. Not only did Sarah invest more money, but she bought shares at high prices and low prices, which mathematically gives her a better average cost per share over time. The best part? Sarah doesn't spend a single minute worrying about market timing, reading financial news, or making emotional decisions. She just gets richer automatically. Your emotions will sabotage your investing success. Automation removes your emotions from the equation entirely. Rule number 4. Know the difference between net and gross returns. Investing always comes with fees, management fees, transaction costs, advisor fees, and more. Ignoring them is like ignoring a slow leak in your bank account. Let me show you why with a simple example. Mike and Kevin both invest $10,000. Mike chooses actively managed mutual funds with a 3% management fee. Kevin chooses index funds with a 0.5% fee. After 30 years, both generated the same market returns, but Mike's portfolio is worth $76,000, while Kevin's is worth $152,000, double the money just from paying attention to fees. Think of it this way. Those small percentage fees aren't taking a small slice of your pie, they're taking an entire future pie you'll never get to taste. When someone tells you an investment has a great return, always ask, is that the net return I'll actually receive after all fees and taxes, or the gross return before all that gets subtracted? The net return is the only number that actually matters. This is exactly why index funds are so powerful. They track the market instead of trying to beat it, and they charge minimal fees, often below 0.1%. Here's the real kicker. Studies consistently show that about 90% of professional fund managers fail to beat the market over a 15-year period. You're paying them extra to underperform what you could get from a simple index fund. Warren Buffett is so confident in this approach that he bet $1 million an S&P 500 index fund would beat hedge funds over 10 years. He won easily, not because he's a genius, but because the math is that simple. Now, all these rules are great, but they're useless if you don't actually implement them. The biggest threat to your financial success isn't the market. It's your own tendency to procrastinate and overthink. Most people will watch this video, nod along thinking, that makes sense, and then do absolutely nothing with this information. Don't be most people. These 4 investing rules aren't complicated, but they separate the wealthy from the broke. Start investing as early as possible. Focus on not losing money. Automate your investing to remove emotion. Pay attention to fees and taxes. While everyone else is gambling on get-rich-quick schemes, you could be quietly building real wealth in the background. The question isn't whether these rules work. History has proven they do. The only question is whether you'll actually use them, or just keep doing what's comfortable. Every day you delay implementing these rules is stealing money from your future self. Start now, even if it's just $50 a month set up on autopilot. Your 60-year-old self will either be thanking you or cursing you based on what you decide to do today.